Fiscal year 2025 on Equity Market Insight by UTI Mutual Fund. This is our monthly series where we delve into the updates and outlook on global and domestic economic trends, market valuations and outlook, and we also cover an in-depth update on one of our fund's strategies. I am Sonal Mittal, Product Specialist at UTI Mutual Fund, and I'm joined by our esteemed speakers, Mr. Beatrice Subramania, Chief Investment Officer at UTI, and Ms. Preeti, who is Fund Manager for UTI Banking and Financial Services Fund. Post presentation, we will take up Q&A. Please note, you can post your questions anytime during the webinar on the link provided to make most of this opportunity. Without further ado, I will now hand over to Vetri. Thank you.
Good evening, everybody. Thank you for joining us on this edition of the Market Insight for Equity, April 2024, new year beginning, at least the financial year. And of course, this time we have my colleague Preeti as well, who will be covering the Banking and Financial Services Fund. Subsequently, Preeti has been with us right from her passing out of MBA from 2012, and she's been an analyst, covered sectors like auto ancillaries, financials, and now, of course, she's both our lead analyst for financials as well as runs the fund. So she's going to be taking you through the Banking and Financial Services Fund, which happens to be one of the sectoral themes which we are quite positive about at this point of time. So without any further ado, I'll also request Sonal to bring up the presentation. And as usual, I'll first take you through a little bit of the macro and also what our current sort of thoughts on market are. And then after that, Preeti will come back on to run through the deck and then finally Q&A. So what we've got here on the first slide is essentially looking at something that, I actually talked about this even way back in November of 2023, when we talked about the fact that, debt to GDP ratios for many economies was going up quite significantly. And this is what you can see on the left-hand side, which is during the period of the pandemic, US national debt is started accelerating very significantly. And based on the projections which are available, it is likely to hit $40 trillion somewhere in 2025 in the second half. So this is an significant acceleration in the trend of debt for the US economy. And if you look at this slide, which goes back on the left-hand side all the way to 2000, what you'll see is that there was one significant acceleration which took place after the global financial crisis, and the second acceleration takes place in 2020 when the pandemic hits. And as a result of that, what you're also seeing on the right-hand side is what we believe is a significant degree of risk which is opening up in the US financial system, because even as the Fed has increased rates quite significantly at the short end, remember the US policy rate is now at 5.25 plus, we've actually seen the US Treasury increase its borrowing through short-term routes. So when you look at the chart on the right-hand side, what you will see is that there has been a significant increase in issuance of treasury bills, which typically have a life of maximum of 1 year, rather than issuing of dated securities. And this creates its own risk, because clearly what the US Treasury has done is taken a bet that these rates which currently are prevailing in the US economy are very high, and at some point there will be rate cuts, and therefore they would rather borrow short term and then wait for rates to come down before swapping their borrowings to a slightly longer tenure. But this is a view that they have implemented, and every view comes with risks. The risks as we see them are simply the fact that US rates don't look like they're going to go down in a hurry. I'm talking about the short-term yield. And similarly, there are also risks at the long end, simply because of their need to issue at the long end, combined with the Federal Reserve's need to reduce its balance sheet. So this is a view that they have taken. Let's go short-term borrowings. Hopefully rates will come back down and then we can borrow at the long end. But I think this is a very risky premise that they have gone ahead with. The reason to worry about their debt is on the next slide. And what you can see on the next slide is the rising interest bills that they are facing. And just from the point of view of juxtaposing it, because anybody who started their career in the early 90s, India started liberalization in 1991. That is a period when we really started to get very conscious about fiscal deficits. And I would say particularly over the last decade, we've been very disciplined in terms of our fiscal deficit. On the left hand side chart, you can see how absolute interest payments in the economy have behaved. The purple line is India's interest payment, and on the yellow line, what you see there is the US interest payments. This is just the absolute number. And what you can see over there is that in India's case, we've had a continuous increase in interest payments over a period of time. But having said that, it's been very consistent in terms of its trajectory. But look at the US, and while it was consistent post-pandemic period, there's a significant acceleration which happens in their interest payments. And if you go by the projections that the Congressional Budget Office has put up, then it's very likely that this number will continue to accelerate. Whereas if you look at the right-hand side, what we have done here is not look at the absolute interest payment, but look at interest payments as a percentage of GDP. Now, in India's case, we used to be fiscally profligate, but over time, we've brought in the fiscal deficit. And you can see over there is a long period of almost more than a decade when India's interest payments as a percentage of GDP were very stable. Then, of course, we hit COVID. There was a little bit of a bump up, but once again, we've started to stabilize that number. And remember, in India's case, our absolute borrowings by government are actually going to be at an absolute number, almost a flat line from 2021 all the way till 2026. So we are trying to cap the level of absolute borrowing that we are doing. But this is not the case in the US, where deficits are continuing to run at 7% plus of GDP. So you see that sharp spike which happens in the yellow line post-pandemic. And if I were to project forward over the next 3 to 4 years, very likely that the yellow line actually overtakes the purple line of India. And this again sort of leads to the fact that in India, we have prioritized, fiscal discipline. Very interestingly, the Prime Minister was talking at the RBI's 90th anniversary last week, and he actually made a specific reference to this about how in India, fiscal policy and monetary policy are trying to work together to control inflation. And he talked about the fact that the government has walked the path of fiscal discipline. Now, moving away from this topic of debt, I also wanted to sort of introduce one of the implications of fiscal discipline, which is to say, remember, in India's perspective, we are talking now of bringing the fiscal deficit down to 4.5% by 2026, which means from the peak of about 9% plus, which happened in the COVID year, we are almost going to halve it to 4.5%. This will be about 100 basis points higher than where we were in the pre-pandemic period. But a result of this financial, discipline that we are showing, you can see on both slides, on this particular slide, on the left-hand side, we have government capex as a percentage of GDP. The reason the numbers here might look different from what you conventionally hear is that in the budget, the government only talks about direct expenditure in the budget, whereas in this chart, we have combined direct spending by government along with the IEBR, which is the spending and done by public sector units. And therefore, when you combine them, this trajectory looks slightly different. There is a period during 16 to 22 when both government capex and off-budget capex go up quite dramatically. But if you actually see from 22, along with the numbers that we have for 2025, the growth rate is now moderating. And one of the reasons this growth rate in capex by government plus off-budget capex by government is moderating is because of the need for fiscal discipline to bring that fiscal deficit down to 4.5%, which means that the government is constraining its own ability to spend, which is in the long term a good thing. But what it means is that the private sector needs to come forward. On the right hand side, you can see the yellow bar. So the first yellow bar shows you the overall capex growth in the economy between 2023 and finally what is the actual growth which happened in 23, one particular financial year. So you can see over here that the corporate sector, which is the second set of bars, has actually been the weakest in terms of its contribution to capex. In 2023, it's expected to pick up, but still quite weaker than where the government is. And therefore, this is something that the baton will have to pass from the public sector to the private sector, along with households, simply because the public sector is no longer in a position to really sort of continue to accelerate its spending. Moving on, we'll quickly look at just one or two economic trends, but I want to run down to the latter portion. So only point to make over here, there's a lot of data. I'll just highlight two data points. FY24 growth estimates, this is Bloomberg consensus, not the RBI or the government estimate. That's 7.5%. I think the government estimate is much higher. For FY25, the Bloomberg consensus is 6.6%, though the government is still talking about a number closer to 7% plus. And there is some reason to believe that this 6.6% might get revised upward. Current account deficit has now come well back inside the comfort zone of the policymakers. It's now running at about 1.2, 1.3%, which is a very comfortable level. If we move on, the next slide, we can go to the equity markets and valuation. Yeah. So this is a slide where the earnings numbers for March 24 looking slightly better than what we saw, the last month when we did this, though the actual number itself not very different. So this is the number as of March 24, 18% growth. Correspondingly, the March 25 number, which was previously showing 14% growth, has actually been cut to 11%. So the 2-year growth outcome has not changed too much, but the 24 and 25 individual integers have changed. But needless to say, from a strong base of 2023, this amounts to a 14% CAGR over the 23 to 26 period. But as of now, looking at these numbers, the expectation for 25-26 much more muted than anything we've seen in terms of the recent trajectory. Moving on to the next slide, this just shows you the movement in earnings estimates. And you can see over here that on the left side bar, the EPS for March 24, between December 23 and March 24, there has been about a 2% increase in earnings estimates for 24. But for March 25, which is the middle set of bars, the earnings estimates have been unchanged. So which is why the 2-year outcome has not changed, but the individual growth estimates for 24 and 25 have moved marginally. Now, what does this imply in terms of valuations? We can start to look at that at the next set of slides. Yeah, so this is the Nifty trailing PE. As you can see, the trailing PE on the left-hand side, very much in the comfort zone. But on a forward price-to-book basis, the market is certainly now looking expensive. This is, of course, based on its history. And here, when we are looking at the history, what we are looking is at the history over the last 18 years. So compared to its 20-year history, markets on a forward PE basis now looking slightly expensive. On the next slide, we also have the price-to-book. This was one estimate which was still looking quite comfortable till about 2 months ago, but now even the Nifty trailing price to book has become more expensive, rising to a much higher number than where it was in 2021, and that does make this integer also now start to look slightly uncomfortable, and I'll talk about this later. Nifty mid cap, small cap, no change. This has been expensive. It's persisted in terms of being expensive. Nifty mid cap at a record premium to the large cap index. Nifty small cap premium, small cap index, it normally trades at a discount to the Nifty large cap, but unusually it has traded up now to a premium and held that premium for a few months. And this is why, we find a lot more relative valuation comfort in large caps as compared to mid caps and small caps. On the next slide, we've also got the yield difference. So here what we are looking at is the 1-year forward earnings yield of the Nifty 50. What is the earnings yield of the Nifty 50? All that we do is that we take the Nifty PE multiple, 100 divided by the PE multiple of the Nifty 1-year forward. So that gives us the number in terms of the earnings yield of the Nifty. And we are comparing that to the 10-year GSEC. And that difference right now is at 2.3%. On a 1-year basis, this indicates indicator tends to have a very strong correlation with equity market returns vis-a-vis bond returns. So on a one-year basis, this indicator is telling you that fixed income is more favorable than equities. That's the message from this historical valuation indicator. I'll just jump through now finally to the conclusion slide. We've already talked about mid cap versus large cap. So we'll just go to the conclusion slide. So these are some of the points I wanted to make. Now, many of you would remember that when we spoke in January 2024, we were talking about the fact that the market was estimating 5 to 6 rate cuts. And we said this is a very high bar. It's not clear that this estimate can be met. That is pretty much what has happened. Markets have now backpedaled and markets are now estimating less than 3 cuts. So 3 cuts, 25 basis points each would amount to 75 basis points of rate cut this year. Market is now estimating that it could be somewhere between 50 to 75 basis points in the US. Having said that, I think the challenge is longer term interest rates in the US. For the reasons I mentioned before, there is a higher fiscal deficit that they are continuing to persist with. Not clear that even if a change in the government from current Democrats to Republicans would actually cause the trajectory of deficits to change. And therefore, you've got supply side pressure of bonds simply because the Treasury needs to borrow more. Simultaneously, the Fed is still on target to try and reduce balance sheet, though this time the Fed chairman indicated they can rethink the pace. But essentially, the supply of bonds, to my mind, creates headwinds for long-term US yields to come down, even if they are able to cut their short-term policy rate over the next 12 months. In India, the MPC remained in pause mode. Growth is very strong in India. We already know that. The February print for inflation was about 5.1%. And the MPC and governor are continuously saying that, their target is actually 4% inflation. So if growth is strong and inflation is about target, they have every reason to stay in pause mode. And that is exactly what they are doing. I've talked about the dichotomy in valuations with the mid cap and small cap trading at a premium to large caps. What is the message, therefore, from these valuations? Our bias very clearly, therefore, is towards large caps as compared to mid and small caps. And, investors should adopt a staggered approach. If you have got lump sum amounts to invest, then we think the sort of asset allocation strategies which are managed more dynamically, like the balanced advantage fund, the multi-asset fund, and equity asset fund are far more favorable. Over the last few months, whenever I've talked to you about this, we've talked about equity allocations, being in the range of closer to 54-55%. The model is now actually dropping closer to about 50%. So we are quite close to seeing another reduction potentially in the equity allocation closer towards 50%. I think our multi-asset allocation has already dropped allocation to 50% this last week. So as markets go higher in terms of valuation, these range of hybrid funds which use dynamic asset allocation are responding to the higher valuations by reducing their allocation based on when the trigger actually tells them to do it. Two of the sector funds that we think are attractive, these are good, perhaps beta investment opportunities. Top of the table is the Banking and Financial Services Fund, where we think valuations are attractive. Preeti will talk more about that. Healthcare Fund, we've been recommending for a while. It did quite well in 2023. It's done well year to date as well. It's no longer attractive in terms of valuations, but just on a relative basis, we still have some degree of comfort in that sector. Finally, the Innovation Fund, which is another sector, more a thematic fund than a sectoral fund. It's a pretty volatile fund because concentrated portfolio. All the companies are looking at transformational opportunities. But for long-term investors, we think this is a thematic fund where SIPs continue to look quite attractive. So that's about it from my side in terms of how we read the macros and what some of our thoughts on the equity and hybrid side are. But I'll take a pause over here and hand over to Preeti and request her to take today's webinar forward in terms of a discussion on the Banking and Financial Services Fund. Over to you, Preeti. Preeti, you're on mute.
Yeah. Thank you, Vetri. Thanks for the introduction and also the macro overview and outlook that we have. As Vetri introduced and suggested that I'll be covering the Banking and Financial Services Fund. I manage this fund, and I also cover the sector for more than a decade now. So speaking about the sector itself, I think this is something where the touch and feel of the sector is something experienced by everyone. So when we make case for investing in BFSI sector, it is easier to understand as we march towards a 5 trillion and then 10 trillion economy. So credit, or let's say the banks, are going to play a key role in this story. So banks will be key beneficiaries from, be it from consumption or manufacturing, or even in the growth of the the smaller and medium enterprises that we have in the country. So historically, and if you look at the data, how that has performed to back this up, so credit or basically the loan growth, it has grown at least 50% higher than the GDP growth. That's the nominal growth. So and which gives us a makes a strong case for investment there, where we have this visibility of higher growth than the GDP itself. And in terms of when we look at the health of the balance sheet, given that they are highly leveraged businesses, so they are in one of the best times, given that the profitability is at its best in a decade, and they're also well capitalized to support this growth that we expect to come. And I would like to answer two questions here: why BFSI sector itself, and why now? So here, if we do get exposure to BFSI sector in a big way in diversified fund, but investing in the BFSI sector will also provide an opportunity to invest and participate beyond lending. So typically, I think many of us would have exposure through our diversified funds in large banks. So since the space itself has expanded, we have seen companies getting listed in insurance, fintech, capital marketplace. So I think that's something where we can go down in terms of the market capitalization curve, and also participate in some of these structural stories that the country offers. So that is why we would recommend BFSI sector, which gives us much deeper exposure to the sector themes itself. And two, why now? We have seen the sector underperform for 3 years in a row, and we have seen when it turns around, there is quite strong outperformance. That's what the history suggests. And valuations, importantly, are at longer term average, which gives us the comfort to make a case for investment into the sector. So moving on to the next slide. So I'll just cover 3-4 slides talking about the sectoral trends. So the left-hand side chart talks about how historically the credit on an average has been higher at least 50% higher than the nominal GDP growth. And the second chart talks about, there has been talk about, the consumption-driven credit growths. But despite all the consumption-driven credit growth, like be it in terms of, let's say, the retail loans, in terms of vehicle loans, home loans, or even personal loans, our household credit as a percentage of GDP is quite comfortable at 36%. So we have not seen meaningful leverage or over leveraging at customer level at a very broad scale. So that provides us comfort on the bit on underwriting, and as well as the asset quality performance in medium term future. The third is the capacity utilization. So while if you just see the last decade, the consumption-driven credit has done very well. The industrial credit, the credit that goes to large businesses, manufacturing business, etc., has been muted. But we expect this to pick up as the capacity utilization moves from 75% to 80%. That's the time when companies go for capex, and after the deleveraging that we have actually seen, so we expect this to be a meaningful driver for the credit going forward. And the third bit is the SMEs that I spoke about earlier as well. Post GST has also become a key growth engine for the sector, given better disclosures on which the banks are able to underwrite. Banks and NBFCs are both able to underwrite better. So this talks about the health of the banks. As you can see, the first chart talks about capital adequacy ratio. They're very well capitalized, which is basically the level of capital which stands at 17%, and it's at again almost 20 years high. And as you can see, it's supported by one of the best asset quality performance, like net NPAs are the lowest, and it continues to do so even in 2024, which is reflected in a way in your profitability as measured in return on assets. So this is again at 15-year high, and when we expect this to sustain, it has sustained in 24, and we expect this to sustain in 25 as well. Because we do not see any volatility that we saw back in 2017-18, which was also triggered by the AQR, the asset quality review by the regulator. We are not seeing any excesses, and the underwriting has improved for the sector itself. So this is the beyond banks aspect that I spoke about, wherein it's a structural trend. We're talking about where the trend. If we just look at three aspects here in terms of cashless transactions itself have doubled in 5 years, and thanks to UPI. So even the even the smallest vendor is able to transact on a digital rail, and it's also getting captured, and they're also activating their bank accounts out of necessity. So that is definitely leaving a digital trail, and that's helping some of the financial services itself, the products itself, to pick up. So one is, let's say, the banking. The basic savings account itself, the savings account, and then let's say a fixed or term deposit account, and then comes let's say a slightly more matured investor or customer can look at investing in mutual funds, and that's reflected. That's what we talk about. Equities are still very just 7% of the Indian financial household assets. So it's still a very small proportion, even after the growth that we have seen in the sector at 55 lakh crores of AUM. And the chart on the below is the demat accounts. So here, this basically is the participation in capital markets in, let's say, stock markets or in terms of depositories or exchanges, etc., the market infrastructure players. So that is something, as a sector fund, that will be able to invest in some of these opportunities, which we expect are to be structural and have a long runway of growth. This is in terms of, let's say, beyond lending aspect, insurance as the disposable incomes increase. So I think the population would also look to cover or protect the family in terms of, let's say, life, and also as the non-life insurance products, be it in terms of property or vehicle, etc. So even which are not mandatory as a risk mitigant. So we would actually see the insurance also pick up, insurance penetration also pick up. And here as well, because of the listed space which has expanded over the last 5 to 6 years, we do have opportunities, and private sort of dominates in both life insurance and non-life insurance, with almost 3/4, with almost 2/3 the market share, and they continue to do well, continue to gain market share from the public sector players. So with the fundamental growth drivers in place, when we look at the valuations for the sector at an overall level, it gives us comfort because it's at average valuation. So as we just looked at for the market, especially especially on the mid cap and small cap, which are at +2, closer to +2 standard deviation, this gives us comfort that it is at average valuations. And even when we break it up into certain segments, there are definitely segments which provides us opportunities for longer term investing, and as we play for the mean reversions in terms of the valuations. So this is an important slide which highlights how the outperformance has been, and on a 3-year basis. If you see the table below, in case of FY 17, whenever the sector outperforms, it has been meaningful in the range of 700 to 900 bips, and and for 3 or 4 years. And we have actually seen for 3 to 4 years the underperformance has been quite sharp vis-a-vis the Nifty 50 index. So we expect, given the fundamentals and valuations are falling in place, we expect the sector to be at an inflection point and to actually display some of the performance that's played out in the past as well. And speaking about the sector, the fund itself, so if you see the benchmark is dominated by banks, so 93% is banks and NBFCs. But we do have exposure to insurance and capital markets. That's what we've been talking about in terms of overweight, and also in terms of market cap as well. So it's a largely large cap oriented benchmark, but we're running with 30% mid cap and small cap, where we find the valuations are still comfortable, and some of the opportunities fund that we spoke about. And I think that's the two bit that I would leave with, in terms of beyond banks and in lending, and also beyond large cap. I think that's what we are targeting through the sector fund. So do we have the next slide?
That's it, Preeti. Thank you. And now we will move on to the questions and answers.
Sure.
Thank you, Vetri and Preeti, for sharing your insights. The webinar is now open for Q&A, and I invite the participants to share the questions in the link provided and make the most of this Q&A session. While I wait for the questions to queue up, let me begin with the questions that we have already received. So the first question is for you, Vetri. As we step into FY25, do you think risk and rewards are quite evenly balanced right now, or do you think markets could be disappointed disproportionately?
Well, that's an interesting question, and the only way to reply to this is always from a valuation perspective. Valuations reflect potential which has been discounted in the price. And therefore, once the potential is already discounted in the price, stocks need to deliver that, which means it is now down to implementation. They need to deliver the earnings. And secondly, to really be able to give you something in terms of icing on the cake, they actually need to outperform the expectations that are already discounted in the valuations. Now, if you look at everything that we looked at in terms of valuations, that is a cause for concern, because, the margin of safety is now very, very thin. Stocks are priced quite perfectly relative to their potential. And this is reflected in multiple ways. We looked at the valuations of the Nifty large cap, unusually trading at a discount to small caps, leave alone the mid caps, which does happen in the past as well, but small caps is unusual. So I would say essentially the concern is one of valuations. The risk lies in implementation, which means companies have to deliver the earnings that are expected of them, and then do slightly more simply because your valuations are already at a significant premium to the long-term average. And the other way to think about this is that, we also remember at that valuation indicator which compared equities to bonds. I would actually submit that what that valuation indicator is telling you is that on a 1-year basis, as of now, you could potentially get, or that's what the model is telling us, better return from fixed income than you could get from equity. So that's the way to think about risk and reward.
Sure, thanks, Vetri. My next question is for you, Preeti. PSU banks have delivered generous returns in FY24. However, you have low exposure to PSU banks in the funds portfolio. So what is your view on PSU banks compared to private banks in terms of fundamentals and valuations? Preeti, you're on mute.
So we have a neutral exposure in terms of PSUs. And as you rightly said, they have done very well. We have seen a catch up in terms of valuations, especially for, let's say, the tier 2, tier 3 PSU banks in the last year, as they delivered this 1% ROA. So partly when I showed that ROA chart, so good part of that is reflected because of the recovery that we have seen in PSUs over the last 2-3 years. There is a slide on the valuations. Is it possible to pull it up? Yeah. So this is what I was talking about in terms of the valuations. If you see over a decade, we have seen the valuations on a 1-year forward basis. The PSU banks have related substantially, which were probably trading below 0.5 times during the pandemic, and also during the crisis that they were going through post the asset quality review. So we have seen a fair recovery, and the valuations, I would say that they are more or less in the fair region. So now it's more a compounding play, and where we have comfort in terms of the execution and sustenance of the ROAs closer to 1%. I think that's how we are selective in terms of PSU banks. And connecting that with private banks is that's where the valuations have actually they have actually seen a sort of derating, and they are at -1 standard deviation compared to the longer term trading, and we expect some part of this to mean revert on both ends, since our strategy is anyways bottom up picking. So we are looking at the book value compounding in both space, and taking active calls on where we have the most conviction.
Sure. Thanks, Preeti. My next question is again for you. RBI has recently tightened the norms on unsecured lending or personal loans. So what are your views on this regulatory tightening from RBI?
So if you see the commentary from the regulator, it's more on the unsecured loans or the personal loans. And they have rightly so increased the risk weights just to target this specific segments and not any productive segments. The regulator did highlight that they have seen some bit of excesses built into the small ticket lending, which are like less than 50,000. And they form a much smaller proportion of personal loans itself, and hence the overall banking credit. So we're not seeing any kind of immediate risks in terms of asset quality for the banks or NBFCs at this point of time, because this segment was predominantly it was done, or let's say the lending was done by fintechs. So we're not seeing any of that impact our listed space in terms both for NBFCs or banks, but we will definitely see some of the underwriting practices to get sharpened from here on. And I think that's a good measure from the regulator to actually not see any of the excesses build up and then go through a cycle.
Sure. Vetri, the next question is for you. While equity investors are cherishing the strong economic data, what is the impact that we will see on the markets from a no change in stance from the recent MPC meet?
Sure. It is exactly as I said, as long as the economic data stays robust, and as long as, therefore, inflation stays above what the RBI and particularly Governor Shaktikanta Das has reiterated is a 4% target, there is no reason for the MPC to actually cut rates. So, we do think there could be some back-ended cuts in rates. Remember, RBI's own projection is that it will go down closer to 4.5. But, therefore, it's going to take time before you can see them cut. Their priority at this point of time is more to get inflation down to target rather than worry about growth. Why should they worry about growth? Growth has actually been surprising on the upside compared to their forecast 1 year ago. So I'm not expecting them to do anything in a hurry.
Sure. My next question is again for you only. What are your views on the significant rise in energy demand in India?
Sorry, will you repeat that?
What are your views on the significant rise in energy demand in India? Sure.
So I would say, there is no data indicating that energy demand in the economy has particularly accelerated. If you look at the trend line over a longer 5-year, 7-year period, we are still going pretty much as per trend in terms of the overall growth perspective, nothing unusual. And there is some volatility related to, again, pandemic year, post-pandemic. So look at longer term data. But having said that, without doubt, because of the challenges that many people who built power plant, particularly generation assets during the previous upcycle all the way up to 2012, very little new capacity has been built in power plants which can meet what we call the base load power requirement. So, things like thermal and gas, which can always stay on and generate power. There is not enough of that which has been built over the last 7 to 8 years because nobody wanted to invest in that area, also because of ESG considerations. So even though we have added a lot of capacity in the renewable space, the challenge is that there are certain times of the day where the demand supply balance has become slightly more challenging. And we did see, therefore, in the merchant market, some of these prices went up sharply a few months ago. And at this point of time, given that we are entering peak summer, there is some concern once again that in those peak hours, there could be some challenges. I would essentially say that, there could be some companies who have merchant capacities who could benefit from this. But in the longer term, companies are working on solutions to figure out how to balance the grid better. Some of this could involve solutions like, pumped storage. Some of these could involve new technologies in battery storage. Remember, recently there was a tender for battery storage capacity, which actually surprised everybody by being much cheaper. The bid was much lower than what people thought it would be at. So some of these technologies are still emerging. Some of these projects will have to come on stream. But at an aggregate basis, I still think there is a reasonable sort of balanced between demand and supply of energy. It's at peak hours where there is a little bit of a mismatch. And as I said, there could be some power companies that benefit from this. But longer term, as you see more and more renewable capacity come on stream, energy pricing will also become much more dynamic. Prices could fall much more sharply during peak hours where renewable will be generating power, which is, say, the daylight time when the sun is out, and then there will be a mismatch at hours where you don't have the sun out. So a lot more cyclicality in terms of the supply pattern in the days ahead.
Sure, Vetri. Preeti, I would request you to take up the next question. Expectations of Fed's rate cut have been dampened and extended to second half of 2024. This has pushed rate cuts in India as well. So what is the sensitivity of possible rate cuts on Indian banks?
Right. So if you talk about the sensitivity itself to earnings, assuming a 25 bips to 50 bips rate cut, it could be anywhere between 5 to 8% in terms of the earnings cut. But the important point to note is that when the regulator started the hike cycle, the upcycle, so it was pretty short and quite steep, right? So it was 250 bips hike in a very short period of time. So we did see the banks did get the benefit of it in the rising rate cycle. They did enjoy some of the best of the margins in terms of because of the repo rate cut hike. So because going forward, the rate cut cycle itself will not be so steep. It will be a shallow rate cut cycle, and it could also be spread across and not as short, or let's say shorter duration the way it was on the up on the way up. So we think that the impact would also be not as sharp on the earnings. So that's how I would put it. But even building in the impact on the earnings, the book value compounding should still be in mid-teens range, even after factoring in the impact, because they would have some levers in terms of the operating cost, and we also believe that credit cost continues to be benign for the sector. So these are the two levers that the sector have to manage the headwind that there will be in terms of the NIMS compression that can happen post the rate cut.
Sure, thanks, Preeti. The next question is on market valuations, and I would request Betty to please take this question. Market is expensive since last long. Do you think technical factors are gaining more importance than that of fundamental factors? And do you think it can last for long?
That's hard to answer. Nobody knows how long the markets can, sort of say disconnected. But eventually, I would say, look, companies and markets can only deliver what companies deliver in terms of their return on equity and what companies can deliver in terms of earnings growth. Those two numbers are actually, linked together symbiotically if you understand the equation. But just for the purpose of this discussion, they are linked. And therefore, you cannot have markets continuously generate returns well in excess of what underlying ROE and earnings growth are. And that is the reason I think that, you have to worry about valuations. Now, sure, technical reasons can help for some period of time. And I've experienced this in my career as well over 30 years. There are periods when the market can stay irrationally exuberant. There are periods where it can stay irrationally depressed for longer than expected. But one of the most powerful forces of nature also operates in the markets, which is the reversion to mean. And every time the market strays too far away from the mean, eventually it finds some reason to come back. And the reason it comes back is that market volatility is much higher than underlying corporate profit volatility. So I think the only prudent thing we can do as investors is not necessarily predict when those inflection points will happen. But as an investor, it is important to prepare yourself for the potential risk of mean reversion. And that is why I always say it's better to prepare than to predict. So I know the question was about how long can this last. Unfortunately, I don't have an answer, but the data is telling me that be prepared for it. And therefore, I think as a prudent investor, the right thing to do is to prepare rather than predict.
Sure. Thanks, Vetri. Preeti, I would like to take this question. What is the downside risk to the banking and financial services sector?
I think the unknown risks are the asset quality risks, because it is in highly leveraged businesses and it's a post facto thing that we all know. We believe that underwriting is better than the last cycle, and we are obviously tracking the data, but it is lag data. So I think that goes without saying for the sector. And in terms of let's say beyond banks, when we talk about in terms of valuations, like the mid cap, small cap valuations, they are also getting reflected in obviously the sector level mid cap, small caps as well. So I think that would be another risk that I would say.
Sure, thank you, Preeti. Vetri, since you touched upon innovation funds, so we have this question on the fund. Will innovation fund continue its overweight stance on IT?
Sorry, will you repeat that?
Will the fund will continue to have overweight stance on IT sure. sector?
Yeah, but just to be clear, the innovation fund doesn't really look to invest in traditional IT services businesses, because that is not the focus of the portfolio. The focus of the portfolio is actually to invest in companies which are using technology to achieve certain end objectives. So they are actually looking more at investments in companies which are technology-led platform businesses, but we do have some investments in companies which are in the technology domain, but they are involved more in really R&D being done in the technology space rather than the classical IT services space. So if you look at the innovation fund and the exposure that we have in the classical IT sector, what's important is to go down and look at the companies which are in the portfolio, and you'll find that they are more sort of product oriented, they are more earning a revenue share rather than being companies that just build custom designed IT solutions for large corporates. So we will always have a large exposure to those kind of product companies or companies which have non-linear business models, right? So the classical IT services company is a linear business model. It tends to have a very stable profile of the capital invested structured, the kind of personnel required to create revenue, and therefore cost per employee and revenue per employee are directly correlated. Most of the companies that we own, revenue per employee and cost per employee is not directly correlated because they do not need more employees necessarily to generate revenue. So that's the difference between the kind of companies that we have in the innovation portfolio and the kind of companies you typically experience in classic IT services.
Sure. Thanks, Vetri. Preeti, the next question is, given the rapid advancement in fintech and digital banking, how does the fund incorporate innovation and technology trends into its investment approach within the banking and financial services sector?
Right. In terms of the listing that goes, especially in the fintech space, it has been limited. If we can say maybe 2 or 3 companies which got listed over the last 2 to 3 year period. But the trend that we have seen is that there has been more collaboration between the big entities like the banks or the NBFCs with the fintech. So they are not necessarily going into going public, but they are key partners and collaborators with the with the entities in the banking space or in the financial services space, which enable them to basically to enable them to be more agile in this digital economy is what I would say. So it is more an enabler. We do not have many big players. Like I think a couple of names that I can think about is Policy Bazaar is one of the new tech company which went public in 2021, and also there was Paytm, which was the poster boy of fintech. But there were not many in terms of, let's say, big fintech names or let's say innovators which are public as of now.
Sure. Thanks, Preeti. In the interest of the time, I would like to take 2 or 3 max questions now. Preeti, next question is for you only. What are the reasons for the underperformance of private banks, and when or how do you see it can reverse?
So I would say it's probably the availability of alternatives. So as the performance of the other private banks or smaller banks or PSUs themselves improved as they were coming out of a cycle in terms of the asset quality issue that they had, and also the some sort of perceived stress related in the pandemic. So they were available at much attractive valuation, and they were also starved for capital in the last cycle, and they were renewed with capital to come back to growth. I think that's what I would say. The flow of capital went from fairly valued businesses to undervalued businesses, where you saw that re-rating happen from under the book value to actually up close to book value. I think that's what I would say. So now that the valuations are fair for, let's say, PSU banks and some of the smaller banks as well, smaller regional banks. So we would think it will track the fundamentals and the earnings, since valuations have also corrected for private banks. So they're fair both in case of PSUs and private banks. So we would think that it will track, and the structural the franchise strength of private banks continue to stay. So they have gained market share away from public sector banks, be it because of their efficiencies or investment into sales, tech, etc. So that continues to stay with the private sector banks, and as they continue to outperform, be it in terms of loan growth or advances, or continue to deliver better profitability. So we would see when the expectation or the delivery of growth is strong, is much higher than what we are all building in. That is when probably all the engines sort of fire in terms of, let's say, the consumer, corporate, and SME. I think that's where the mean reversion could be at a play in a larger way.
Thank you, Preeti. Vetri, I think our viewers are following you on various platforms, and this question is from one of your interactions where you mentioned that you're bullish on India and not on the markets currently. Do you see the market returns have been front-ended and there is a chance of Japanification of India, as we have seen it happen in case of China?
No. I don't think that is the takeaway anybody should have. I think very, very far from Japanification, either in terms of our demographics, the kind of debt overload we have, and the growth opportunity that still exists as an economy for us. That is more a very near-term question in terms of over the next 1 year. And, it goes back to some of the valuation models that we looked at. And if you look at those valuation models, that is why I would say, fixed income actually, to my mind, looks very attractive as compared to what equity is. That's what the models are telling us. So that is from that perspective of a year or so, maybe even a 1 to 3 year period, where I would say, look, it all comes down to how you think about investing, right? And I always say something can be a good company, it may even be a great company, but it need not be a good stock. It may be a poor stock. The reason it is a poor stock is not because of anything it did, but simply because the burden of expectations, which is already captured in the valuations, is a very significant weight. And then you run into what I call implementation risk, or the fact that real events may not match up to what was actually factored into the valuation. So that is really the challenge of where we are in terms of the equity market. It has nothing to do with our potential as an economy. I never discussed potential over there, right? So the potential is there. It is something we should stay excited about. It's more in this 1 to 3 year window that I would say that, equities have run too hard. You front loaded some of those returns, as the viewer correctly said, and that's where there is scope for disappointment.
Sure. Thanks, Vetri. And my last question is for you only. In the current environment, based on valuations and outlook, how do you view attractiveness of hybrid funds?
Sure. Sonal, I would actually say some of these hybrid solutions are actually the best solutions in the current environment. Why? Because A, they are dynamically managing their equity allocation, and those equity allocation, and those equity allocations are being managed based on valuation. So we are not predicting anything, but we are preparing for what could be the risk, and that is done by bringing down the equity allocation. As I said, in fact, the models are now closer to 45% equity allocation in the range of 30 to 90. And that tells you what the model is telling you about the attractiveness of equity allocations. Similarly, the allocation to fixed income has gone up simply because, as I said, those are attractive. And the beauty of this hybrid structure is that it's able to own equity and fixed income. And at the same time, the taxation treatment is superior to what you could get by directly owning fixed income. So I would actually say in the current environment, the schemes which are using some dynamism in their equity allocation, this could be the balanced advantage fund, this could be the multi-asset allocation fund, which, mind you, also has gold, and gold has been a big contributor to performance of that strategy in recent months. And finally, there is also the equity savings fund, which manages its equity allocation dynamically in a much tighter range. But all of these three are good solutions for investors who would like to get the benefit of the attractiveness of fixed income, combine it with the relative unattractiveness of equity in the short term. And remember, in this portfolio, if things change 1 year later, the equity allocation may as well, go back up quite significantly. So this is a portfolio which is able to ride out those cycles in the market in a very efficient manner without bringing in any personal interpretation or biases. It's driven by the model, the asset allocation, and therefore it enables you to ride these cycles with much lower volatility. You're on mute, sir.
Yeah. Thank you, Vetri. On behalf of UTI Mutual Fund, we extend our sincere gratitude to all our participants for participating today. We trust that today's session provided you with enriching insights, offering a comprehensive update on the macros, equity markets, and a deeper understanding of UTI banking and financial services funds, investment strategy, and philosophy. We also hope that your queries have been answered to your satisfaction. If we have not been able to take up any of your queries, please do write it to us and we will try to respond to them. Please share your feedback on the link provided. Special thanks to our esteemed speakers, Mr. Vetri Subramaniam and Ms. Preeti, for sharing valuable insights and addressing the questions. As we conclude, we encourage you to stay connected with us for future events and updates. Your interest and involvement make our webinars successful. I now request Vetri to please share the closing remarks before and post which we can conclude the session. Thank you.
Sure, nothing to add, Sonal. Thank you very much for hosting this and anchoring today's Market Insight. Thank you, Preeti, for being here. And of course, the biggest thank you to all of you who have joined this webinar today. And thanks for sending in your questions. It's actually the questions which make these webinars more interesting. So do keep the questions coming. And we look forward to speaking to you again in a month's time. Have a great evening.
Thank you. Thank you, everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.